Hey, everybody, it's Mark Yegge. Welcome back to another weekly market update for January 20th, 23. We are off to a great start this year. Even though everybody was bearish about the market's off to a good start. We are green, and I'm going to show you that in just a second. But I hope you're able to take advantage of the market and the fact that we have a nice green market. Let's see what screen is shared here. This really bugs me. Hopefully that screen is shared. I'm going to assume that screen is shared. All right. So we've got 4 green lights in the market, and we are doing well. We're cranking up. It's been about 2 weeks of upward market movement, so that's been really good. The Nasdaq is the weakest link in our indexes this year, and they have been for a long time. But I think the Nasdaq, the tech stocks are starting to rebound, and I think we may be even a little bit pleasantly surprised with the over corrections of these stocks based on earnings when these earnings are coming out, and they're coming out soon. So you're seeing the Nasdaq above its 50-day moving average, but it's still below its 200-day moving average, that black line there. So you've got to kind of watch out for that. Nonetheless, it's over the 50, and we'd like at least to be over the 50. And hopefully, if we can keep this green sustained, we're going to head up to that $11,571 high. And then from there, there's a 12,770 or 12,270 high. That's an interim one that gapped down right after. So hopefully we can get up in that area, and then that would put us above the 50 and the 200-day moving average. That would be good. But that's the weakest part of the market that I'm going to report to you today. The S&P 500 is really kind of shoring up here. Notice how the drops, if you go all the way to the left side of the screen from 46.37 to 36.36, that's like a 1,000-point drop. Then the next drop is 43.25 to 34.91. That's like a less than 1,000-point drop. I guess it's like 800-point drop or something like that. 43, whatever it is. No, not 1,000-point drop. Yeah, it was 1,000. Okay, so anyway, you could see it's less of a drop, right? And then you go to the 4,100 down to the 37.64. Now you're talking about even a smaller drop. That's called a volatility contraction pattern. And so generally when the market contracts less and less each time, it starts to figure out a pattern to go the other way. And this red line going through the black line, that's called a golden cross. When it comes up, like it'll probably do next week, if we get some strength in the market, we're going to have a golden cross. The street, the big money, looks at golden crosses like an opportunity to put money in early. And so those are generally, crosses that portend a longer term trend. We'll see how it shakes out. The Dow Jones Industrial Average is the strongest of all the indexes, except for the New York, which I'm going to show you in a second. And you could see a beautiful trend starting in October all the way up. Then we had a correction in December as people took those tax losses off the board. And then we rebounded early in January. And then we had a big correction a couple of days ago on low volume, though. So, the Dow is pretty much beating all the other indexes. I think it's coming back to the mean. And then everything always converges anyway. So that's what I think we see going on. The sell-offs are not as weak, not as strong as they are weak. So that's probably positive. But the New York above its 50, above its 200, above its 10, above its 21, got a golden cross a couple weeks ago. The New York is telling us something here, folks. The New York is telling us, first of all, it's a very broad index. It's telling us that there's strength in this marketplace. We got to listen to that. Now, will the other ones kind of come up with it? Maybe. I think they will, because we're in a new year, green market, a lot of bearishness over the last year. It's still continuing, and when there's a ton of bearishness and people give up, you get capitulation that goes up the other side. So we'll see if we get some of that. I'm going to show you a couple of other interesting charts. The volatility, the lower the volatility, the higher the market wants to move. So as volatility decreases, people are willing to put their toe back in the water and try to get some increases in the market and maybe take advantage of a market that's about to go up. That's what's going on. If you look at these bottoms, 1845, 1912, 1895, those were the bottoms before little moves to the upside, or big moves in some cases. And that's usually what happens. And these moves to the downside are when volatilities, as they grow, volatility is increasing, people are more bearish. These I find interesting. Oil services have been incredibly strong, most of the year, but they did have that period of time in the summer last year where they basically dropped. But overall, oil and oil services have been a great sector, and you get a lot of success from the strength of a sector behind you. And the oil service sector right now is looking really, really good. I was just amazed to see how well it's doing, because I know oil prices have actually come down lately, not a lot, but they've come down a bit. And that makes a difference. And they're still pumping out oil, and they're still putting in new wells. And you don't even hear about that. I don't know about the new wells thing. Let me correct myself, but they must be doing something because they're the oil service index. All right, gold and silver. What this is telling us is it's been a really lousy, 8 months of the year. But now the oil service index is saying, you know what? We don't believe the Fed anymore. We think the Fed's got to print money. I think they're right. And if the oil services market is telling you that the Fed's got to print money, you ought to listen, because that's inflationary. Inflationary means they're not going to be able to raise rates too much more, even though they say they are. I'm waiting for a Fed pivot any day. I'm always early, so I don't know when it's going to happen. But they're at least going to stop raising rates when they get enough data that the inflation is slowing or stopped. So the gold and silver index is calling them out on that. I find that interesting. And the housing sector index. Housing is not as bad as everybody is saying. There's still housing sector building and strength going on right there. And even though everybody's saying, oh, the housing market's tanking because rates are going up, rates are actually coming down a bit. And therefore, the housing market is showing us that it's not as weak as, say, 2008 when it was like dead. And that there's still some strength in it. So just a few green shoots out there in this market. We've been really used to people talking down the market for the last year, 14 months or so. I think it's time to get ready for the market to go the other way. I don't know how long this green market is going to last. I hope it lasts a long time, and I hope you get to take advantage of it. And you didn't go to cash, and now you're sucked into all this fear, and then the market bounces and does stuff from here. As always, this is education, not a recommendation. Go see a financial advisor or somebody that you trust. I'm just giving you my opinion on what I do. If you want to know more about what we do here at the Wealth Investors Club and the Cash Flow Machine, hit us up somehow in this group or underneath the video or to comment. You got to be able to figure out a way to find us on the internet. And then we can certainly talk about it more. We have a group on the internet called the Wealth Investor Stock Trading Group. It's on Facebook, so you can hit us up there, and that's probably where you're watching this. So listen, thanks for checking in and tuning in. I hope to see you next week on another edition of the Weekly Market Update. Have a great weekend, everybody. Take care.